While everyone was watching oil, the real kill switch flipped in silence. Brent crude surged from $70 to $120 in 10 days. The Strait of Hormuz closed. 6.7 million barrels per day vanished from the market. Financial media ran wall-to-wall coverage. Traders, politicians, analysts, all eyes on the same choke point, on the same map, watching the same price move. Nobody was watching the Federal Reserve's balance sheet. Nobody noticed the line item that spent 3 years ticking towards zero and finally registered $330 million on a Sunday night. Not trillion, not billion, million. That line item is called the Reverse Repo facility, and its exhaustion is the most consequential financial event of the decade, one that happened without a single press conference, a single headline, or a single alert on your Bloomberg terminal. Here is what the financial press missed. While the loud crisis was playing out in the Strait of Hormuz, the silent one was already complete. The $2.5 trillion buffer that held the US Treasury market together, the overflow tank that absorbed sovereign debt shocks, neutralized the Fed's tightening, and kept yields artificially suppressed, was gone. This is the briefing they didn't give you. In this video, what the reverse repo facility actually was and why it existed, who drained it and how the mechanism worked, who stepped in to fill the void when it ran dry, and why those players are the most dangerous cornerstone in the history of US debt markets, and exactly what the sequence looks like when their leverage breaks. $120 per barrel. That was Brent crude on Monday morning. Not a forecast, the actual price, flashing red on terminals across London, Singapore, and New York. Here's what happened. The Strait of Hormuz closed. That choke point carries 20% of the world's daily oil supply. Kuwait, Iraq, Saudi Arabia, the UAE collectively dropped 6.7 million barrels per day off the market by March 10th. 10 days earlier, Brent was at $70. It crossed $100 on Sunday night, then $110, then $120. Price didn't drift higher, it snapped. Because when a buffer disappears all at once, that's what price does. There is a second buffer, one that doesn't move oil. It moves money. And its drain is the story nobody covered. The reverse repo facility is an overflow tank. After the pandemic, the Fed flooded the system with cash. Trillions, almost overnight. Money market funds suddenly had more liquidity than they knew what to do with. Yields were near zero, nowhere safe to put it. So the Fed opened a window. Bring us your cash overnight. We hand you treasuries as collateral, pay you a modest rate, you collect everything back in the morning. By late 2022, $2.5 trillion was parked there every single night. Meanwhile, the US Treasury was running a peacetime deficit with no historical precedent. Federal debt grew by over $2.2 trillion in 2025 alone, pushing the total past $38.5 trillion. The traditional buyers, the Fed, China, Japan, were gone. China dumping treasuries to buy gold, Japan selling to defend the yen. The structural bid for US sovereign debt had quietly vanished. So the Treasury did something clever, a deliberate pivot. Historically, the Treasury locks in debt for decades, long-term bonds at fixed rates. But with no buyers for long paper, they reversed course. Flooded the market with short-term bills instead. Bills that money market funds actually want. Bills yielding just enough above the reverse repo rate to make the switch worth making. Here's the mechanism. Money market funds see a Treasury bill paying slightly more than the overnight RRP rate. They pull cash out of the Fed's facility and buy the bill. The government gets funded. The RRP drains. Liquidity appears to be flowing naturally. It looks like organic demand for US debt. It isn't. It's the government cannibalizing its own safety buffer to fund its own deficit. Moving cash from one pocket to another and calling it a market. $2.5 trillion, then $1 trillion, then $500 billion. Then, on March 9, 2026, $332 million. A rounding error on a system that used to hold enough liquidity to absorb a sovereign debt shock. No emergency press conference, no crisis headline. Just a slow, silent drain, while everyone was watching equity markets make new highs. So who buys the debt now? The answer is going to make you angry. When the traditional buyers retreated, something had to fill the void. What filled it was a class of player never designed to be a cornerstone of sovereign debt markets. Hedge funds running what's called the basis trade. There's a tiny, persistent price gap between Treasury futures and the underlying cash bonds. Fractions of a percent. On its own, too small to matter. But here's what these funds do. They borrow against it, aggressively, at 50-to-1 leverage, $1 of equity controlling $50 of government debt. That fraction of a percent, multiplied across $50 of notional exposure, becomes enormously profitable. Run it across hundreds of billions in positions, and you're printing money. Until you aren't. The funding comes from the repo market. The fund pledges the Treasury bonds as collateral, borrows overnight cash, rolls the position the next morning, and collects the spread. It works beautifully in calm conditions. It requires stable short-term funding costs, low volatility, and, critically, a functioning collateral market. Remove any one of those three things, and the leverage that generated the profit becomes the mechanism of the destruction. These funds aren't buying treasuries because they believe in America's fiscal trajectory. They're exploiting a price gap. Price-sensitive mercenaries in a market that used to be anchored by institutions with strategic mandates to buy regardless of yield. A central bank cannot be margin called. A hedge fund can. The trade depends on cheap, stable, short-term funding. It depends on volatility staying low enough that the leverage doesn't kill you. But with the facility gone, there is no buffer left. Every tremor hits directly. We already saw this movie in March 2020. That wasn't just pandemic panic. It was a basis trade implosion. Hedge funds dumped nearly $100 billion in treasuries into a void, forcing the Fed to print $1 trillion in 3 weeks just to stop the bleeding. Today, the trade is larger. The leverage is higher. The buffer no longer exists. The snap is no longer a tail risk. It's a proximity risk. Stop for a second, because I need to talk to you directly. Not about basis points, not about auction mechanics, about what this actually means for the person watching this video. You have spent 30 years playing by the rules, contributing to the 401k, rebalancing the portfolio, trusting that the bond allocation was the safe half of the equation. You did everything right. And the entire time, quietly, without a single press conference or a single headline, the people running this system were draining the buffer that made those rules work. Your retirement savings are priced off Treasury yields. Your pension fund holds treasuries as its safe allocation. The collateral backing every short-term loan your bank uses to function, treasuries. The foundation isn't made of granite. It's being held up by a handful of hedge funds running 50-to-1 leverage, and the overflow tank that used to cushion the whole thing just hit $330 million. You aren't crazy for feeling like the floor is getting thinner. You aren't paranoid for sensing that the stability you see on the screen doesn't match what you feel in your gut. You're just paying attention to the plumbing they built behind a wall and hoped you'd never find. That's why I left the desk. Not to manage someone else's billions, to tell you what those rooms actually look like when the screens go vertical. Now let me show you what happens next. The liquidity snap. What happens when we hit zero? Go back to Monday morning, March 9th. Oil traders watching Brent surge past $100 for the first time since 2022. The Strait of Hormuz closed. The buffer, the 20% of global daily supply that ordinarily flows through that choke point, suddenly gone. Price didn't walk higher, it snapped. The bond market snap works the same way, but faster, and with less warning. It begins at a treasury auction. The room that's supposed to be full of bidders goes quiet. Money market funds have no excess cash left to redirect. The RRP is empty. Basis trade funds are tapped out on 50-to-1 leverage, already at maximum exposure. The only buyers left are primary dealers, the banks legally required to buy whatever the market rejects. But their balance sheets are already stuffed with government paper from the last 3 years of record issuance. When demand falls short and yields spike harder than expected to clear the auction, it's called a tail. A severe tail is not a data point, it's a trigger. Here's the sequence. The tail reprices every treasury on every bank balance sheet in the country, overnight. Treasury securities are the foundation of the repo system, the collateral that every institution pledges to fund short-term operations. When that collateral drops in value suddenly, the haircuts widen. Margin calls go out. The basis trade funds get hit first. They're the most leveraged. They sell treasuries to meet margin calls. That selling pushes yields higher. Higher yields devalue the collateral further, which triggers more margin calls, more forced selling. The loop feeds itself, each iteration faster than the last. Private credit funds with hundreds of billions locked in illiquid loans cannot sell their way out. Their assets don't trade. There is no bid. Even money market funds become forced sellers, not of what they want to sell, but of what they can sell, which in a treasury snap is treasuries, the very asset whose price is already collapsing. The Fed will intervene, they always do. But intervention takes time to organize, time to communicate, and time to execute. In the gap between the snap and the rescue, enormous damage gets done. Here's what that looks like in real time. Not in theory, not in a stress test model, in practice. There's a phrase that traders use in moments like this. They call it a no-bid market. Nobody is buying, not because they don't want to, because they can't. The mechanism that would normally bring buyers into the room has been drained away, dollar by dollar, over 3 years, until the tank registered $330 million on a Monday morning while everyone was watching the price of oil. Here's the part that almost nobody sees coming. The Fed's traditional rescue plan, the one that stopped the bleeding in 2020, might be the very thing that triggers the final collapse this time. The rescue could be the trap. The Fed knows this. They built the standing repo facility after the 2019 blow-up. They printed $1 trillion in 3 weeks when the basis trade imploded in 2020. They know exactly what lives inside that leverage. But the dilemma is structural. Restarting quantitative easing to stop a liquidity snap reignites the inflation problem they spent 3 years fighting. Every emergency intervention confirms to the world that stability in US debt markets is manufactured. And manufactured stability, once exposed, breeds confidence collapse that no intervention reverses quickly. Move too slowly, and the forced liquidation loop ignites. Move too fast, and they validate every fear about dollar credibility. In 2008, the buffer was full. Today it reads $330 million. That's not a buffer. That's a memory. Here's what you actually do with this information. The snap doesn't announce itself. It doesn't wait for a convenient headline or a scheduled Fed meeting. It arrives inside a treasury auction that tails harder than expected on a Tuesday morning while everyone is watching oil prices. Watch the SOFR rate. Watch the term premium on 10-year treasuries. Watch the auction bid-to-cover ratios. When those three things move in the wrong direction simultaneously, the proximity of the snap collapses from weeks to days. The Strait of Hormuz closing sent oil from $67 to $120 in 10 days. Everyone saw the choke point on a map. The Treasury market's choke point doesn't appear on any map. It appears on a Federal Reserve balance sheet line item that almost nobody reads. That's why you're watching this. And that's why this matters. If you want to go deeper on how the basis trade actually works and what the March 2020 implosion tells us about what comes next, that video is right here.